There was a guy in 1978 named Ted Benna who found a loophole in a tax bill nobody was paying attention to. A two-paragraph provision buried in the Revenue Act. The IRS wasn't even sure it was legal. He used it to create what we now call the 401k. And within a decade, corporations across America had quietly replaced pensions, guaranteed income for life, with this new thing that put all the risk on you, the worker. I'm not saying Benna was evil. He thought he was helping people. But the system that grew up around his idea? That's a different story. My name is Larry, and I spend way too much time reading the fine print on retirement vehicles. If you've ever wondered why, no matter how much you contribute, retirement still feels impossibly far away, and why your wealthy neighbor seems to play by completely different rules, stick with me. By the end of this, you'll understand the structural ceiling built into your 401k, the tools the top 1% use to get around it, and exactly what you should do right now, depending on where you are in the wealth building race. Let me start with a number, $23,500. That's the 2025 IRS contribution limit for a 401k if you're under 50. Sounds generous, right? Here's the problem. That number is the same whether you make $60,000 a year or $600,000 a year. But what it represents as a percentage of your income is completely different. A surgeon making $600,000 puts in $23,500 and barely notices. That's less than 4% of income. A teacher making $55,000 who maxes out their 401k just contributed 42% of gross income. Which one do you think is actually able to max it out every year? This is what I call the flat ceiling problem. The government created a system that looks equal because everyone gets the same dollar limit. But equal limits in an unequal income landscape are not actually equal. They're a ceiling that only constrains the people who need room to grow the most. Now here's where it gets structurally interesting because the wealthy figured this out decades ago. Think about the 401k like a standard apartment lease. You sign a lease, you get one unit, you pay your rent, your contribution. You get your space, tax-deferred growth. Sounds fair. Everyone in the building has a lease. But what you don't know is that the landlord in the tax code has a penthouse floor that isn't listed in the main brochure. The people on the penthouse floor aren't leasing, they own, and they've got tools that make your lease look like a studio apartment. Let me show you the penthouse. The first tool is called a cash balance plan. Most people have never heard of it. It's technically a pension, but self-directed. A business owner, or even a solo consultant, can contribute up to $300,000 or more per year in pre-tax dollars depending on age. $300,000, not $23,500. A 55-year-old business owner combining a 401k with a cash balance plan can shelter over $350,000 from taxes in a single year. That's 15 times what a salaried employee can put away. Same tax code, radically different outcomes. The second tool is the backdoor Roth IRA. If you make over $161,000 as a single filer, you're technically not allowed to contribute to a Roth IRA. But here's what the tax code actually says. You can contribute to a traditional IRA with no income limit and then convert it to a Roth. 2 steps, same result. Every financial advisor to the wealthy knows this. Most people making $80,000 a year have never been told. The third tool is the taxable brokerage account with tax loss harvesting. This sounds complicated, but it's not. You own index funds. Some go up, some go down. You sell the ones that went down, book the loss to offset your gains, buy a similar fund immediately, and maintain your market exposure while reducing your tax bill. Wealthy investors with dedicated advisors do this automatically. The average 401k holder doesn't even know it's an option. Here's the psychological trap the system sets. You max out your 401k, feel good about it, and think you're doing everything possible. And you are, inside the box they gave you. But you were never told there's a door in the wall. Let me give you the math on why this matters so much. Meet 2 guys, both 40 years old, both earning $200,000 a year. Marcus is a salaried corporate employee. He maxes his 401k at $23,500 a year. He invests another $7,000 in a Roth IRA through the backdoor method. Total tax advantage contributions, $30,500. Daniel is a consultant who incorporated his business 4 years ago. He runs a solo 401k plus a cash balance plan. His total annual tax advantage contribution, $180,000. Same income, same age. 840% more money going into tax-sheltered growth every year. At a 7% annual return over 25 years, Marcus retires with approximately $1.9 million in tax-advantaged accounts. Solid. That's top 5% of Americans. Daniel retires with approximately $11.4 million from the same income over the same time period. The difference is not intelligence. It's not discipline. It's structural access to tools that most people don't know exist. Now I can hear what you're thinking. Larry, I'm not a consultant. I have a regular job. I can't just create a cash balance plan. And you're right. But here's what you can do. And this is where most people leave enormous money on the table without realizing it. Step 1. Audit your actual tax situation before your next open enrollment. Most employees pick their 401k contribution in October and forget about it until the following October. But your tax situation changes every year. Did you get a raise? Did your spouse change jobs? Did you have a kid? Each of these creates planning opportunities. A $500 session with a fee-only CPA, not a broker, not a financial advisor who earns commissions, can identify deductions and contribution strategies you didn't know were available. The average person who does this for the first time finds $3,000 to $8,000 in annual savings they were leaving behind. That's $3,000 to $8,000 you could be compounding for 25 years instead of writing a check to the IRS. Step 2. Open a backdoor Roth IRA if your income is above $100,000. Even if you're nowhere near the phase-out limits yet, establish the habit now. A Roth IRA is the single best retirement account for most people because growth is tax-free, withdrawals in retirement are tax-free, and there are no required minimum distributions. The money compounds in a tax-free environment for decades. The backdoor method removes the income restriction entirely. It takes about 45 minutes to set up through any major brokerage. Most people never do it because nobody explained it to them in plain language. Step 3. If you have any self-employment income, any at all, open a solo 401k, a freelance photographer, a consultant who does weekend work, someone who sells things on the side. If you earn even $10,000 in self-employment income, you can open a solo 401k and contribute up to 25% of that income as an employer contribution on top of the standard $23,500 employee contribution. That means someone earning $60,000 at a regular job and $30,000 freelancing can contribute $30,500 from the day job limit plus $7,500 from the freelance income. $38,000 total into tax-advantaged accounts versus the $23,500 they thought they were limited to. Step 4. Stop treating your taxable brokerage account like a second-class citizen. People think of their 401k as the real retirement account, and their regular brokerage as just savings. But a taxable brokerage account with low-cost index funds and basic tax loss harvesting is an incredibly powerful wealth-building tool. You get full liquidity, no contribution limits, no withdrawal penalties, no required minimum distributions. The trade-off is you pay taxes on gains, but with index funds and long holding periods, you control when those gains get realized. Step 5. Understand sequence of returns risk before you're 10 years from retirement. This one keeps me up at night on behalf of people who don't know about it. The math is brutal. 2 people can earn the identical average annual return over a 30-year period and retire with wildly different outcomes based entirely on when the bad years hit. If the market drops 35% in the 3 years right before you retire, and you're fully invested in stocks, you permanently impair your portfolio. Not temporarily. permanently because you're withdrawing at reduced prices, which means your remaining shares have less time to recover, which means you run out of money while you're still alive. The 4% withdrawal rule assumes a diversified, rebalanced portfolio, not an all-stock portfolio you panic sold during a crash and moved to cash. The people who retire comfortably are the ones who started de-risking their portfolio gradually at 55, not the ones who woke up at 62, panicked during a correction, and sold everything. Here's the bigger picture that ties all of this together. The 401k was a political compromise between corporations that wanted to ditch expensive pensions and a government that wanted people to save without a massive new public program. The contribution limits were never designed around what a median worker actually needs to retire. They were designed around what was politically negotiable in 1978. The system is not broken. It's working exactly as designed. It just wasn't designed primarily for you. It was designed for the employer who no longer wants pension liability on their balance sheet. It was designed for the financial industry that earns fees managing the trillions now sitting in 401k plans. It was designed for high earners who can max out contributions without feeling it, use every advanced tool available, and retire wealthy. That doesn't mean you can't win inside this system. You absolutely can. But winning requires knowing the rules most people were never taught. It requires understanding that the $23,500 limit is a floor for some people and a ceiling for others. And that which one it is depends entirely on whether you know what's above it. The people who retire at 60 with real financial independence aren't smarter than you. They're not luckier. They found the door in the wall, and now you know where it is. Go check your contribution rate tonight. Open that backdoor Roth if you haven't. If you have any freelance income at all, look into a solo 401k this week. And if you're within 15 years of retirement, get a fee-only advisor to stress test your sequence of returns exposure. Not because the market is going to crash tomorrow, but because by the time it matters, it's too late to prepare. The retirement system was built around a version of your financial life that was decided by other people for other reasons. Understanding that is the first step to building the version you actually want. Subscribe if this helped, and drop a comment. I want to know, did you know about the cash balance plan before today? Because most people don't, and they should.